There is a lot to consider when investing. You have to think about what to invest your money in, when to invest it, how much to invest in, and with all this going on, you probably don't think about the biggest thing that you also need to be aware of is yourself. So. And if you like making more money and keeping that money, then subscribe to my channel because I make videos on those exact topics. Unless there are some investing bots out there that watch my YouTube videos, then I'm gonna just assume that you are human, just like the rest of us investors. And that means that there is a whole lot of psychology behind your investing decisions, even if you might not be aware of it. There are so many hidden factors that drive our everyday decisions, and sometimes it's so automatic that we don't realize that these biases are shaping our actions. In this video, I'm going to give a list of 5 behavioral biases that can impact all of us and our investing decisions. The first one is loss aversion, and this refers to the preference that people have to avoid losses. And of course, that's a good thing. We all want to avoid losing money, but loss aversion is caring more about preventing loss than actually making profits. And it shows itself in some really interesting ways. Wow, this stock went up 10% since I bought it. I need to sell this right away to be sure I lock in those profits. I mean, my high yield savings account is at like 1%, so I should just keep all my money there. I don't want to risk putting it in the stock market. Oh my gosh, this investment's gone down 10%. Oh, I need to sell it. I don't want it to go down anymore. I don't care if the company's doing well and making money. I don't want to risk it. I always say that it's not always about how much you make, it's how much you keep. But that doesn't necessarily mean loss aversion. In addition to just having the self-awareness of what is driving your investment decisions, there's some other ways that you can counter loss aversion. For example, if you invest your money in one area, say the stock market, and you're worried about losses, you can make a second investment that moves in the opposite direction of that, such as bonds in this example. They are known for having an inverse relationship, and one goes up, the other goes down, and so you can really balance that out and you don't have to worry so much about focusing on your losses. You can also invest your money in securities that are known for not having huge fluctuations in their price. A good example of this would be in index funds. The next one on my list is the confirmation bias. People often gravitate towards information that reflects their own beliefs. For example, you might prefer a certain news channel because they are known to reflect your political beliefs. This can also be dangerous because with a confirmation bias, when you come across information that reflects your own opinion, you place more importance on those facts because it supports what you already think. You may not be willing to be challenged by other information either. You are crazy for investing all that money with different companies. I just stick to my company's stock purchase plan and I invest only in them because I know they are a great company. I mean, I work for them, I should know. I am only gonna read these news articles because they make me feel good about the investments I'm making. When I was looking up different examples of the confirmation bias, I came across a really fun one. And it was to imagine that if you believe all left-handed people are more creative than right-handed people, anytime you encountered a creative person that was also left-handed, you would just accept this as evidence to further your belief. And you wouldn't be challenged by the idea of coincidence or that right-handed people could be creative too. To counter the confirmation bias, you can pay attention to information that counters what you believe to be true about a certain company or investment. Always default to facts. Take a look at the company's financial statements, for example, and see if the numbers in those statements support the opinions that you're reading in articles. The third one is called the recency bias. This skews the investor perception to focus on the short term and really makes you think that current trends will continue for the long term, and that's just not possible. The stock market has very clear and distinct patterns, and one of the biggest mistakes is that people think this time it'll be different. And it never is. The trends never last forever. The market can go up at crazy rates, but it's not sustainable to continue growing at that rate. And the same goes for market decreases. Just because it might be decreasing at a fast rate, it doesn't mean it's going to continue at that rate to zero. We have tons of history to back that up. And thinking that this time is going to be different is a frequent trap that a lot of investors fall into. Dang, this company's increased 50% this year so far. Man, 2020's been crazy. Man, at that rate, I could be really rich by this time next year. Oh my gosh, the stock market is plummeting right now. I need to sell everything and take all my money out. I knew I should have just stuck with real estate. Sell. To counter it, have very specific investment goals and don't get caught up with short-term price movements in the stock. Proceed with caution if the financial information that you're referring to talks about trends and momentum and really buys into the hype of these things continuing at the same rate. The hindsight bias is probably the one that impacts me the most. This is when an event happens and the investor says, "I told you so," or "I knew this was gonna happen," but in reality, they had no way of knowing that event would actually occur. How I know that I've been victim of the hindsight bias is I feel frustration and regret because after a certain event happens, I beat myself up because I should have seen it coming. Whether a price was going to fall in a stock or increase and I should have bought it sooner, I can really beat myself up because hindsight's 2020 and I should have seen it. But really, there's no way I could have known. Wow, Tesla's gone up over 900% this year? Jeez, I knew it. I mean, I have no experience in the industry and know nothing about the company, but I knew it was gonna take off and be successful. You know, I bet it's because I just really have a good sense of what's gonna be successful and I need to trust my gut more. You know, I should just buy stock in this company too. I don't know much about them, but I knew Tesla was gonna be successful, so I'm just gonna go ahead and do it. $10,000, buy. As humans, we tend to overestimate the accuracy of our predictions. This can give us a false sense of security that we just have a really good gut instinct about certain investments and can get us to act a little bit impulsively and ignore facts. Really check your self-confidence and see if you're acting on this inflated ego or if you're really looking at facts and figures and financial performance of a company before investing. I know that for this fifth one on the list, you are going to say that you are not guilty of it. But if I can admit that sometimes I partake in this bias, then I think you can stop lying to me and yourself. Number 5 is herd mentality, and it is really being influenced by certain trends in the market that get you to invest maybe in things you don't understand or things that are outside of your predetermined investing strategy. You really need to have discipline and self-awareness to look at your potential investing decisions and really consider why you're making that decision. Does it fit into your financial plan, or are you getting caught up in the hype? Wow, the market sure has been going up higher this week. Bet that probably means it's a good time to buy. These people probably know things I don't know. Buy. No, I totally trust you. You've done really well and made some money with stocks, so I agree with you. I should just go ahead and put 40% of my money in that company. Oh my gosh, what is going on? These stocks are plummeting. Oh my gosh, okay, I need to sell. These guys are probably onto something. Sell all. This is why I like to write everything down and know what kind of companies I would invest in and what kind of opportunities would make me act. Trust me, I see plenty of people getting rich on their investing decisions, and it makes me really want to jump on board with certain trends. I just want to be one of the cool kids too. But if you can't tell, that's investing with emotion, and we need to focus on investing with logic. Hopefully this summary of these 5 behavioral biases really helped open your eyes of different things that could creep in and unintentionally influence your investing. I think what it comes down to is your particular investing goals and coming up with your strategy for investing. You should know what type of investor you are. For example, I'm a dividend investor, so I know that is a factor of a company that I really look at. You should know how you feel about investing in certain industries, such as the banks, healthcare companies, technology is a big one. If that fits into your strategy, then great. Determine what characteristics you look for and what makes a good investment for you so that you don't get caught up with all the other hype going on. Also, if you know what your goals are, you can predetermine when you want to sell those stocks. Maybe you want to buy and hold them like me, or if you are saving up for a larger goal, then you know if that stock price hits a certain dollar amount, that's when you want to sell. Or if you want to have a lot of involvement with your investments, then you can choose to follow the company very closely. And when you feel like it is at a good value, which you've predetermined, you can buy that stock. When you feel like it's a little bit overvalued, that's when you sell. You're selling based on your strategy, not because of loss aversion or herd mentality. The best behavioral bias that you can be influenced by though when it comes to your money is following champagne scents. I talk about so many different aspects of money on this channel that it is going to be beneficial. So definitely subscribe now if you haven't done it already, and I will see you in the next video. Thanks so much for watching.